is saying, regardless of what happens there, we're just going to motor on forward with our plans, right?
I think it would be more dangerous if they actually halted the tapering programme and bringing in the instability for markets going back to the will they, won't they period we had in the latter half of last year. So I think the Fed did the right thing. Of course, they've talked about asset market bubbles in length, and so have everyone else. And so I think it would have been more dangerous actually to hold back, pander to what's been going on in emerging markets, which you can argue the degree to which that's been fueled by the Fed or is actually down to more local factors. So I think they did the right thing in continuing along that path.
Okay, so how does this change your targets? We were talking your cable target remains the same, but yen, you revised it since the last few days?
Yeah, I mean, there's a trouble being a yen bear. You're quite often disappointed. And I think the factor on the yen has obviously benefited from the moves in emerging markets. So that safe haven element has come back in, perhaps not as strongly as this was happened 2 or 3 months ago, because the dollar itself has held up well on the tapering argument. So I think on dollar yen, we could still nudge lower to sort of the 101 area. I wouldn't see us going to 100. On the Swiss franc as well, that has helped. But I think the 120 floor on euro Swiss will probably contain that a bit more in terms of strength than the yen. So we have seen that safe haven move, but it's not as being exaggerated, but naturally because of the dollar and the fact that we are also seeing the dollar benefit to a degree.
Simon, it's also interesting to see that, looking at the charts, the rand and the lira as well, they came back up after those shock and awe moves, but basically they're selling off again now.
It's when you central bank raises interest rates as a means to halt currency weakness, as I think was the plan was Turkey, the government was against it. There's always question, investors aren't as fickle as think, okay, great, I'm getting another, couple of percent, and how you split it in Turkey is they change the benchmark rates is difficult. But there's always the underlying factors that are weakening it. So we're not in the situations we were in 98 in Asia, 92 in the UK, when to varying degrees in Indonesia, 98, they were defending pegs to a degree that was seen as unsustainable. 92 sterling within the ERM. So we're not in that situation where pushing against a sort of a dam which suddenly breaks. So that is a different situation. But nevertheless, I think we are going to see further weakness in those countries. Probably Turkish lira up to 240, rand probably up to the 175 area before we see some stabilisation. But I don't think we're in the sort of depths of a full-blown emerging market crisis. It's what happens in EM countries. But what I think is finally interesting is that we are seeing less discrimination so far this year in terms of both deficit countries and also surplus countries such as Hungarian forint and also the ruble being hit just as much as the deficit countries. That was the opposite of the case last year.